So this is 2015 paper, 2015 A11 paper. Saranga PLC, we have the trial balance and the additional information. So as the first step, let's draw the format. We need the income, profit and loss and other comprehensive income, statement of financial position, statement of changes in equity, and two main workings. One is for the expenses, other one is statement of PPE. Draw the format. It's expenses analysis, yes. Can you all hear me? Right. So most of you all have done. So I can start now. So format is one of the key, right? If you do the format, you have done with almost 50% of the question. Right? So next thing is, after the format, you have to start with additional information. Additional information. So let's go through the additional information. Number one. Additional information number one. Adjustments. Before preparation of the financial statements for the year ending 31st March 2015, adjustments for the following have to be made. We need to make following adjustments. The office of the company was shifted to a new premises on 1st of April 2014. 1st of April 2014 means that's the opening, beginning of the year. 2 years rent was paid on this date, and the entire amount was recorded as rent of the current year. So if you check the trial balance, there is rent 960. Right. So let's do working number 3 on prepaid rent. Prepaid rent. Okay. Prepaid rent. Now we have paid 2 years rent on 1st of April 2014. Right. So if you draw the timeline, Our financial year starts 1st of April 2014. 1st of April 2014. This is starting, right? So year end is 31st March 2015. Right? Starting and end. Now this rent has been paid for 2 years. To, to 31st March 2016. So our financial year is only this period. 1st April 2014 to 2015. So how many months, how many years extra paid? Right. Sorry, I got a call. That's why I interrupted. Right. So our financial year is 1st of April 2014 to 31st March 2015. Okay. So this 960 is for 2 years. So 1 year it will be 960 divided by 2. So 960 divided by 2 is 480. So 480 is for current year. Another 480 is for next year. Right. So this is the prepayment. This is the prepayment. Prepayment. So that has to be deducted from the expense, and it has to be deducted from the expense, and we have to take this as the current asset. Current asset. Right. So under description, and I will explain from the beginning. There is a doubt. Now 960 is paid for 2 years. 960 is paid for 2 years. Right. So current 1 year is 480. So only 480 is our expense. Right. Another 480 is paid for next year. So that has to be deducted from the rent. So in your expenses analysis, rent, there is a payment of 960. Out of that 960, you have to deduct 480. Out of 960, deduct 480. Therefore, only 480 is expense for the administration. 480 is expense. Right? And the next year prepayment, we have to take under current asset. So it is taken as current asset, prepaid rent. Prepaid rent for 8. So that's the double entry. We deduct from the rent and record it under current asset. Prepaid rent. Now let's do the second one. Composition of property, plant and equipment and their accumulated depreciation as at 1st of April 2014 is as follows. Land at fair value, motor vehicle, it's a leasehold asset. Now this question was given before the lease Now the lease standard has been changed. The lease standard has been changed. I will do that lease adjustment on, I'll do that on this Friday. Lease adjustment I'll do in the next class. So I will keep the lease adjustment and do the rest. Okay. Motor vehicle, office equipment. All depreciable property, plant and equipment are depreciated on straight line method at 20% per annum. Depreciation has to be provided for the current year. So what I will do is the lease adjustment, I will keep it, right? Let's do it on Friday because there is a change in the lease standard. So I will explain that change and everything. And after that, I will explain the lease adjustment. So therefore, we will keep that. Okay. And we'll do the rest. It won't affect the question. Okay. Now we have 3 assets, and also the land was revalued. Land was revalued on 31st March 2015 at 4.5 million by a professional valuer. So those are the adjustments related to PPE, non-current asset. Right. So come to this statement of PPE. Statement of PPE. Cost. Balance brought forward as of 1st of April 2014. This is the cost. Land value is 6,000. All the values in thousands, right? 6 million. Motor vehicle 3 million. Office equipment 1 million. So you can get the total. 10 million. So that is the amount given in the trial balance as property, plant and equipment. Then the accumulated depreciation, you can see it is 1,000. 1,000 means 600 plus 400. So that also we will take into the statement of PPE. Balance brought forward 1st of April 2014. No depreciation for land. Motor vehicle 600. Office equipment 400. Total 1,000. So these two balances are in trial balance. So we take those balances. Right? So complete that. First record the opening balances of land, motor vehicle and office equipment. Opening balance. Now first I will do the revaluation. Revaluation. Now the land value is 6 million, but it was revalued for 4.5 million. So it's a revaluation loss. How much is the loss? From 6,000 to 4,500. There is a 1,500 loss. So that has to be deducted. Yes. 1,500 loss. That we need to deduct. Minus revaluation loss. So double entry for the revaluation is Double entry for the revaluation. Now, already there is a opening balance in the revaluation reserve account. You check the trial balance. Revaluation reserve, 1st of April, there is 1000. All right, the other balances also. Stated capital, there is 5000. Retained earnings, 1794. I will report those balances also. Stated capital 5000. Retained earnings 1794. Right, so these are the opening balances. We are taking these from the trial balance. Write them. Write the opening balances of stated capital, revaluation reserve, and retained earnings. Right. Now we have the land value 6000, but it was revalued for 4500. 1500, it's a loss. 1500 loss. So we have to deduct the land by 1500, then only the land balance carried down as of 31st March 2015 will become 4500. So we have to credit the land. Land account is credit. $1,500. Can you tell me what is the debit account? Where do you debit this? It's a loss. Where do you debit this 1,500?
Profit and loss account.
Profit and loss account. How much? Profit and loss account. How much do you debit? Do you debit entire 1,500 to the profit and loss account?
500.
Only 500. Balance 1,000?
We debit for the revaluation reserve account.
Exactly. Very good, Saina. So revaluation reserve, already there is 1,000. So from that we have to deduct 1,000, because last year, previous year, or before this revaluation, they have made a revaluation initially. So this is a subsequent revaluation, right? So the revaluation can be initial revaluation and subsequent revaluation. Right? So here initial revaluation is profit and subsequent revaluation is loss. Right? So if there is a loss in the subsequent revaluation, up to the point of revaluation profit, we have to deduct the loss from the revaluation reserve account. If you have more losses, there is another 500 loss that has to be taken to the other expenses. Revaluation loss. It comes here. Revaluation loss 500. Right? Here also land revaluation. Land revaluation loss. I'll explain again. Now, land was revalued. Land balance decreased by 1,500. Therefore, land account we have to credit 1,500. right? So normally, if it is the first initial revaluation, this entire 1,500 should be taken to income statement, profit and loss account, as other expense, right? Normally, if there is a revaluation loss, the double entry will be land account credit, profit and loss account debit. That's a normal double entry. But here, already there is a profit 1,000. Therefore, we have to debit the revaluation reserve first. Debit to 1 million, right? And profit and loss account will be debit the rest of 500. And land account, we have to credit 1,500. So this is the double entry. Right? Revaluation reserve, we credited 1,000. Loss deducted from the land, and only 500 will be taken to the other expense. Only 500 will be taken to the other expense. Is it clear? Anuma, Depreciation? There's another doubt. What is the difference between general reserve and revaluation reserve? General reserve means it is from the retained earnings. We reserve and keep for any specific, any purpose. That general reserve can be used for any purpose. It's a transfer. It's a transfer of retained earnings to general reserve. Right? It's a transfer from the retained earnings. But revaluation reserve means you revalue your asset. Right? You know that when you purchase a land value always appreciate. Right? It is not, let's say, 10 years ago you purchased the land for 1 million, but the current value is not 1 million. It may be 5 million. So that additional profit we can recognize in the accounts. So that is revaluation reserve. Right? General reserve is it's a profit. General reserve is a profit. There is another question. In one question, will there be both general and revaluation reserve? Yes. You may have general reserve, revaluation reserve, uh, retained earnings, all. Like I show you one example like this. This is a statement of changes in equity. These are the accounts which come for statement of changes in equity. Stated capital, revaluation reserve, general reserve, retained earnings. Right? Normally our capital, we divide equity capital, debt capital. So this equity capital is what we prepare for statement of changes in equity. Right? In equity capital, we have ordinary shares, preference shares, and the reserves. There are three types of reserves: revaluation reserve, general reserve, and retained earnings. I'll share this. Right. So that's about the revaluation. Next, as I said, I'm not going to do the lease adjustment. Lease adjustment, I'll explain in the next class. Let's do the rest. Right, so from this question, what I want is for you all to understand basic adjustments and the format. I will be discussing another 5-6 questions related to company accounts. Okay, next we have depreciation. There is no other transaction, no any other transactions related to depreciation. We have 20% depreciation rate. Okay. Now, no additional purchases or disposals. Therefore, this is the closing balance. Land 4.5 million, motor vehicle 3 million, equipment 1 million, total 8.5 million. Right. Then depreciation. This is current year depreciation. We don't depreciate land, but we have to depreciate motor vehicle and office equipment. Can you all tell me how much is motor vehicle depreciation and how much is office equipment depreciation? So let's take 20%. Land we don't depreciate. We depreciate motor vehicle 20%, equipment 20%. Motor vehicle, how much? 600. In office equipment 200. Right, very good. Into 0.2, 600 and 200. So these two expenses will be recorded in the expenses analysis. Motor vehicle depreciation, office equipment depreciation. Motor vehicle you can take under distribution. Normally, the question, if you have motor vehicle, take it under distribution because motor vehicles mostly used for distribution purpose, delivery purpose. Office equipment, take it 200. Right. Then there is no other transactions related to PPE. Get the closing balances. Balance carried down 31st March 2015. And tell me what is the final book value amount that you have to take to the statement of financial position, PPE. Yeah. What is the value you take here? What is the value you have to take to the PPE? There is a question. When there is a profit in the revaluation, we have to credit the revaluation reserve account. When there is a profit in the revaluation, we credit the revaluation reserve account. If there is a loss, we have to take to the other expenses. What is the PPE balance?
8,300.
1,500. Yes, it's 8,500. Cost minus accumulated depreciation for each asset you have to take. So is it 8,500? No. 8,500 is cost. So depreciation total is, yeah, wait, 2,000. Depreciation total is 2,000. Then how much is the book value? Book value is 6,500.
So depreciation total is 800, right?
Yes. Okay. Yes, yes. I have not taken the equation. Yeah, right, right. Correct. Depreciation total is 800. Yes, that's correct. So, total depreciation, total accumulated depreciation is 1,800. Book value is 6,700. 6.7 million. So that's the amount you have to take under non-current assets. Non-current assets. So your statement of PPE part is done. Statement of PPE. Right. So you can double check and complete the statement of PPE and get the final balance to the statement of financial position and non-current assets. Very simple. Right. So we did adjustment number 1 as the prepaid rent, adjustment 2 as the revaluation reserve, and adjustment 3 the statement of PPE. If there's any doubts, please tell me. There is a question. What is double entry for revaluation profit? Revaluation profit double entry is land account debit, revaluation reserve account, account credit. This is double entry for revaluation profit. Okay. Land value increase, reserve account credit. Right. Now we are moving to the next adjustment. Adjustment number 5. As at 31st March 2015, the cost and net realizable value of the inventory were 1.8 million and 2 million respectively. 31st March. Cost is 1.8 million, NRV is 2 million. However, the entire inventory was sold on 20th April 2015 at 1.6 million. The directors authorized the financial statement of the company on 15th of May 2015. So this is an event after the reporting period. Right? So we discussed events after the reporting period. Case 10. Right? So this is an adjusting event. We need to adjust this 200,000. Now, version number 5. Closing inventory. Cost of the inventory is 1.8 million. But the net realizable value is 1.6 million. Therefore, there is a loss. There is a loss. So what is the loss? $200. Right? 1,800 worth of stock. You are selling at 1,600. Did I take wrong balance? No, first is 1,800. First is 1,800. Previous NRV was 2,000. Previous, when they are preparing the income statement, when they are calculating the cost of sales, they have taken 2,000. But actually, the NRV is not 2,000. It's 1,600. Actual NRV is 1,600, not 2,000. So we need to write off get 200. What is the double entry for this write-off? Double entry for this loss is, I give the double entry. Inventory account we have to credit, and profit and loss account and the other expenses we have to debit 200, and inventory account credit 200. This is the double entry. Double entry for the loss is profit and loss account debit, inventory account credit. Right. So stock written off, other expense 200. And inventory, if you check the trial balance, they have given the inventory as 2,400. First of April 2014. That's the opening inventory. We have to calculate the cost of sales. If the NRV is greater than the cost, you have to take the cost. So no need to worry about NRV. You can directly take the cost. So working number 6, I'm calculating cost of sales. Cost of sales is not given, so we need to calculate. How to calculate? Opening inventory plus purchases minus opening inventory plus purchases minus closing stock is cost of sales. So opening inventory was given 2,400. Purchases also given here on the top. Purchases 7,500. Right. Now tell me how much is the cost of sales. Tell me how much is the closing stock that you take. What is the closing stock that you take? And cost of sales. Yes. Closing stock, you take the cost, which is 1,000 liter. So cost of sales is 2,400 plus 7,500 minus 1,800. So cost of sales is 8,100. Cost of sales is 8,100. Select amount, funds here. Working number 6. Cost of sales 8,001. Right. Next. So why we take cost? Cost of sales, always we take the cost. Cost of sales. So here always we take the cost. Right. So if NRV is less, the difference we have to take to the other expenses. We put it under other expenses. One, not to the cost of sales. Right. Let's do the next question. Next assessment. Percent provision is made for doubtful debts on the year-end balance of the trade receivables. Right. So 10% doubtful debts. Check the trial balance. Trade receivables 3,000. Provision for doubtful debts 250. So 3,000 and 250. Let's take here. Let's take as another working number 7. Trade receivables. So trade receivables, there is a balance of 3,000. There is a balance of 3,000. Trade receivables minus provision for doubtful debt. And we call allowance for receivables. And take the balance within bracket 250 opening. And the closing balance should be 10%. So 10% means it is 300. So already there is 250 balance in the provision. So we need to increase the provision by another 50. Then only this becomes 300. Right? So net balance is 2.7 million. So this 50, additional 50 is an expense. So we take this into the distribution expense, doubtful debt. Distribution expense 50. Yes. Right. Already 250 is in the account. So we need to increase this by 50. So net debtor balance is 2,700 that we have to take under Statement of financial position. 2.7. Provision means it's last year, similar to this, we have made a provision of 25, 250. This year provision is 300. Last year, they might be calculated 10%. So 10% is 250. This year, another 10% means 300. So already expense 250, another 50 we have to take to the income statement. Last year 250 is taken. This year only 50. Working number 7. Now, okay. If you didn't understand, I will show you trade receivable ledger account. And if you didn't understand, tell me so I can explain in different methods. Right. Working number 7. I'll do it in another way. Trade receivables, there is an opening balance 3,000. Allowance for receivable or provision for doubtful debt, there is an opening balance of 250. There is no further bad debt or anything. So closing balance of the trade receivable also same. Right? No bad debts. So closing balance also same. So allowance or provision for doubtful debt is 10%. 10% is 3,000 into 10%, which is equals to 300. Okay. So this is called under provision. You have 250 in the account. This should be 300. So increase 50. This is under provision. Transfer to profit and loss. Profit and loss account debit. Then if you take the balance, carry it down. Balance brought forward. 300. This is using ledger account. Right? So trade receivable is 3,000. Allowance for receivable or provision for doubtful debt is 300. Therefore, net balance is 2,700. So either you can use this, or if you didn't understand, write this working for trade receivables. So finally, you will have 2.7 million. Is it clear? right? And also there is another question: what is if it is over provision? Over provision means this side. Let's say your 10% comes for 200, then you have to deduct. Deduct means it comes to the debit side of the provision account, and under working distribution expense, it will be minus. Right? This is debit, and working in the distribution expense, it will be minus. Expense decrease. Okay, that's how you do. It is the over provision. Right. So that is about trade receivables and provision for doubtful debt. So net trade receivables 2.7 million. Education, when the business receive the doubtful debts, the provision for doubtful debts will be closed. We don't receive the doubtful debt, it is a general provision that we make from the total debts. Right? So that can increase or decrease. Every year we make a provision. So you compare with the last year and make under or over provision. Right? So under provision means it is treated as expense. Over provision is it will be deducted from the expense under over provision. Right, next. Now there is a error. Following expenses have been debited to sales account. Sales commission, discount allowed for trade receivables. Okay. Working number 8. Sales. Now this is an error. So if you check the trial balance, sales. 12,300 is due. So out of 12,300, sales commission is not a sales, that comes as an expense. We have to deduct. Minus 1,001. And also there is a discount allowed. So both of these balances are not sales, these are expenses. Net sales will be 10,600. Sorry, plus or minus. Let me draw the ledger account. sales account. I'll draw the ledger account. Sales was 12,300. Right? And these two expenses debited to sales account means we have to credit. So credit means sales will increase. Sales commission. Sales commission and discount account. Sales commission is 1,200. Discount is 300. Therefore, net sales total sales is transferred to profit and loss 40,000. Okay, and we have to debit this into profit and loss account. So double entry for this is sales commission account. Error correction. Debit 1,400. Discount allowed account. Debit 300. Sales account. Credit 1,700. So we credited the sales account 1,700. Working number 8. Why credit side? Credit side is here they have said debited in the question. It says the following expenses have been debited to the sales account. This is expenses. Expenses debited to sales account. So you can't debit the expense to the sales account. You have to debit the expense to the expense account. Here, under expenses, sales commission and discount allowed. Sales commission and discount allowed 1,400 and 300. Okay. Right. So we did adjustment 7. Number 8. So let me explain number 8. 50,000 ordinary shares have been issued at 10 rupees per share. It's a share issue to the existing shareholders by capitalizing the retained earnings. So it's a bonus issue. Capitalizing the retained earnings, it's a bonus issue. 50,000 into 10. is 500,000. Right. So what's the double entry for this? It is a bonus issue, or we call it capitalization of reserve. Retained earnings will be minus 500,000, stated capital plus 500,000. Bonus issue. Retained earnings minus stated capital plus. Retained earnings transferred to capital stated capital account. It is called bonus issue. Value is 50,000 ordinary shares at 10 rupees. 50,000 ordinary shares at 10 rupees means 50,000 into 10. That means 500,000. Not 50,000, 5 million, it's 500,000. Instead of saying bonus issue, you can say capitalization of reserve. That is also fine. Here, bonus issue means capitalization of reserve. Right. Bonus issue, or you can say capitalization of reserve. Both correct. Capitalization of reserve or bonus issue. Right. If you want, you can go working number 9. This is value of capitalization. Value of capitalization is 500,000. Double entry is retained earnings debit 500, stated capital credit 500. This is double entry. Bonus issue. Why retained earnings minus and stated capital plus? That is because from the retained earnings, the retained earnings balance, they are transferring to capital, stated capital. I'll explain why this happens. Right. Now, sometimes in the businesses, they will have huge profits. There is huge return earnings, but they might not have cash because of credit sales and different unrealized profits, or not unrealized profit, different other profits, right? Not cash receipts. Company may have a lot of receivables, right? Higher profit, but no cash to pay dividend. So if they don't have cash to pay dividend, what the company does is they will give free shares. Using the retained earnings, they give shares. So the shareholders can buy the share, get the shares, and they can sell that in the market and make money if they want. Right? So if the company doesn't have money to pay dividend, they will do the bonus issue or capitalize the reserve. Okay, so that's the definition for bonus. So capitalization of reserve bonus 500,000. Where and where it is compulsory to include thousands on top of the which accounts. So you don't need to mention in any of the workings. Mention mainly in the other comprehensive, this profit and loss account, SOFP, and also in the statement of changes in equity. In this, mention 1000 in this. Working, no need. Working is, that is only for your calculation purpose. And you don't get marks for the workings. You get marks are allocated for this answer. Okay, so let's move to the next adjustment. There is a question, in every year will they give this bonus issue adjustment? No, not every year. Sometimes they might give you right issue, sometimes they won't give any issues. So depending on the question, so when we do other past papers, you will understand. Next, a few more transactions. The company sells good with a 6-month warranty period. It has been reliably estimated that 2% of the sales value should be provided for this warranty. So this is another standard. Provisions, contingent liabilities, and contingent assets. And I have done this standard in case 37. Provision, contingent liabilities, and contingent assets. So this is a provision. Since we can reliably estimate the value, this is a provision. Now we do another working number. Working number 8. Warranty provision. So it is from the sales 2%. Now we have calculated sales. There were some adjustments for sales. Yeah. Now the sales is 14,000. Sales will take here. Working number 8. Working number 8, we have the sales, which is 14,000. Warranty provision is 14,000 into 2%. So how much is the provision? 14,000 into 2% is 280. That is the warranty provision. Then check for opening balances. Do you have any provisions? There is no provision. So it was fully under provision. Double entry is profit and loss account debit. It is treated as an expense. 280. And you have to credit warranty provision account. So provision for warranty account. It is expense. Warranty provision is 280. The expense and current liability. Warranty provision, sorry, it's distribution expense, 280. And current liability, current liabilities. Warranty provision, current liability. Wait. Current liability and distribution expense. Then we have EPF and ETF. Company's contribution for EPF and ETF has not yet been provided for the entire year. EPF, ETF not calculated. The company contributes EPF and ETF 15% and 3% respectively on the gross salary of employees. Now you have to check for the gross salary. Salary is given here. Salary expense 1,000. So for 1,000 we need to calculate EPF ETF. So already EPF payable Employees contribution 10% recorded, but employer contribution only not recorded. Since the company's contribution not being provided for the entire year, 15% and 3%. So I'll give the double entry for that. Working number 11. Employers, ETF and ETF contribution. Employers, EPF and ETF contribution. Number 1, employers, EPF. Double entry is, this is expense. Right. So they have said it is 15%. EPF expense account. Expense. EPF expense account debit. %15 means 150. Right, 1000 into 15% is 100. And EPF provident fund payable. EPF payable account credit fund. So there is a double entry for EPF, employers, EPF contribution. Right. Number 2, employers, ETF contribution. Employers, ETF contribution. That is ETF expense account debit, which is 3%. 3% is that ETF payable account. So this is the double entry for EPF and ETF. So expense accounts, there is a question, should I provide all working for all the additional information? No, you don't need to provide additional all all these workings. I'm giving this working for you to understand each and every point. Right? So even without the working, you can just do it in the question itself. Employer EPF, employer ETF. More expenses, administration expenses, 150 and 30. Percent is 30, yes. 1000 into 3% is 30. And these are payables, 150 and 30. Already there is a employee provident fund, there is a balance of 100. So under this statement of financial position, EPF payable, already there is a balance of 100 and 150 we added, so total 250. ETF payable only 30. So we recorded here EPF payable. And double entries you can go to EPF payable. Already there is a balance of 100 from the employee. So we add employer's contribution also. Total will be 250. Right. Let's do the last adjustment. It has been estimated that the income tax for the current year is 1/3 of the profit before tax. So that we have to calculate by taking the profit before tax. Income tax is 1/3. 1/3. And income tax paid is given 90. So we have to calculate the payable. Right? So let's do that after completing all other values. Okay. So other than that, we have expenses. I'll explain the income tax double entries. Yes. Motor vehicle maintenance. Distribution. 3 to 1. Motor vehicle maintenance 321. Lease interest. I didn't do the lease adjustment. I just will record this as finance expense. 7,000. Cash at bank 241. debit balance, right? Yeah. 3 months treasury bills, 1 million. So it's a current asset. $1 million. Lease creditors 1788. Credit payables 4,000. Lease creditors, let's take it under non-current liability. So that's all we have. Now taking the balances. Administration, distribution, finance, other. No other income. Uh, Did I take salaries? Salaries we need to. Salaries 1,000. Realistic. So there is a loss. Uh, Right? So if there is a loss, we don't adjust the tax. Uh, the reason for the loss is actually this interest expense. Lease interest. So actually, after when we prepare the lease adjustment, uh, main part of this interest goes to the uh, main part of this lease interest will be deducted from the lease creditors. So that is why there is a uh, loss coming up. Uh, to complete this question, I will make a small adjustment, right? 720, let me right. So to adjust this, I'll take this to complete the question. I will take this 720. I'll add this to treasury bills. Okay. So let's remove this from the. I'll remove this from the finance expense. Just to complete. So if you have done the adjustment, that is fine. Just to complete this, I'll take this under 1720 to the treasury bills. Okay. One third of the income tax, one third of the profit before tax is income tax. Now the profit is 389 into one third. Divided by 3. 130 is the income tax. 130 is the income tax. So already income tax, there is a payment. There is income tax payable is 130 minus 9, 4. That's it. So we can complete the rest. Right. So we take all these balances. Net profit. There is no dividend. Actually, the land revaluation comes here. The amount that we take to the revaluation reserve. Net profit is 259. Stated capital 5,500. There is no revaluation reserve. Retained earnings 1,553. And we do lease adjustment on Friday. Right. Inventories. Closing inventory. I did the adjustment. $1,600. Out of 1,800, we deducted so it's in balance for 13,440. Right. So I did without the lease adjustment. Lease adjustments I will explain that in the next class. Because I need to fully explain the complete lease adjustment because of the new change. We have some notes. Note 1, you can have for profit before tax. So there you have to say profit before tax has been calculated after deducting some of the key expenses. You can say right separately. You can have notes. For that also you get marks. Lease interest is not an income, lease interest is expense. You can take some expenses here. Land revaluation loss 500. Depreciation you can take 800. Stock written off 200. No need to take all, but some of the main expenses you can take. You can also take doubtful debt. PDF. Right? That's it. Okay, so complete this and I'll share this answer. Is it clear? Did you all understood? Right. So in the next class, I'll explain some of the other adjustments. Right. So basically now we did inventory accruals, PP depreciation, the revaluation part. Right. So in the next class, I'll explain the remaining adjustments. Okay. Right. There are some doubts. Inventory, there was the cost was NRV was 1,600. So we have to keep the inventory at the NRV. That's why we have deducted one. Lease interest, I took it as I changed the value. This I didn't consider it as a lease interest because it was a debit balance. I took it to the treasury bills, right? So I didn't take lease interest 720 because I didn't remove. I took the treasury bill as because it's a debit balance. 1800 minus 200 is 1600 because the inventory should be valued at the lower of cost and NRV. So NRV is 1000, your cost is 1800. Therefore, we deduct the 200 loss, make the closing inventory to the NRV. So we'll conclude from this, and in the next session I'll explain some of the other important adjustments. Okay. So good night and take care. I'll see you on Friday.